Okay, Chapter 6, continuing with Part 3. When recording your inventory value, we historically have been teaching you the cost principle. And now here comes your first variation. With inventory, you put the inventory down at its cost or its market if the market value is lower than cost. And it's based on the conservatism principle. You're going to report the most conservative number, not the most optimistic, not the highest, the most conservative. And so if the inventory value increases in value, you do not mark it up. You only show it at cost. But if the market value drops below your cost, you must show that lower market value. And you can apply this in three different ways: to each individual item, maybe only a few items drop in value, maybe to a class of assets, or to your whole inventory. So let me give you an example of this. If I can slide this over, and if this still works, here is a chart. Let me see if I can expand this chart for you. So here is a chart of the corn market, and this is a daily market, and so we've had a bumper crop in the United States. Well, if you are an owner of corn or the farmer of corn, look what your prices are doing. They're going down. And if you had maybe bought corn, let's say you're a cereal company and you bought a huge batch here at $5 a bushel, and now the market value is holding at $3.27, you got to show it this lower value, not on the cost principle. So this will affect your cost of goods sold, as well as your balance sheet ending inventory value. And so it is the most conservative method for doing so. Okay, next slide here. This is just going to go through some examples. I don't think I'm going to lecture this. I think you can read this. It's just going to show the lower value you must be reported when you're marking down your value here. As you can see, their total market value, total cost, you show it at the market value. If your cost was 45 but the market value is lower, then you show it at the lower. And here the market went higher, but you show it at the conservative value. So it's at cost or lower is the key point here. Again, this slide just shows you how many companies are using various methods. Again, almost half is using FIFO, 1/3 is using LIFO, 20% is using average cost, and they say other. It's other specific identification. I don't know why they listed other. You do need to understand how this valuation is going to affect both your income statement as well as your balance sheet. And the method you choose can have different effects based on either if prices are increasing or decreasing. Increasing prices, commonly known as inflationary prices. Decreasing is known as deflationary prices. And they will change because of the valuation of your inventories maybe being affected or not being affected, as well as your income. And the reason why it affects the income as well as your balance sheet, because it's affecting your cost of goods sold. So you can show a higher cost or a lower cost based on these. So you might want to look at this slide and study it again for the test. I'll probably have that. And again, they'll have a balance sheet effect also. Of the increasing costs FIFO will approximate, whereas LIFO will significantly understate. To help you with this, I think that bucket approach will help you if you just think about pricing there. How would it affect your cost of goods sold or your ending inventory on there? So why do companies use LIFO? Because historically we are inflationary biased in our economy. As a rule of thumb, the government probably inflates around 2% right now. The feds do have a policy of trying to maintain around a 2% inflationary rate. Another way you could say, of course the politicians don't advertise it this way, is that we are going to debase your currency at a rate of 2% a year. And hence, you have a period of increasing prices over time. And the reason people use LIFO is that because it will lower your income taxes, because It increases your cost of goods sold, resulting in a lower net income, resulting in lower taxes. And so that's why a lot of people do use LIFO. Accounting standards require firms using LIFO to report the amount if the firm had been re-reporting FIFO, and this is to allow a comparative basis on this. And it's known as a LIFO reserve, this amount of difference. Here's an example of Caterpillar reporting it versus LIFO versus FIFO method. Again, you'll need to know the financial statement effects of inventory, because it'll either overstate, which will understate income, or understate cost of goods sold, or overstate. There's sort of a balancing act there. And so there can be an effect to both the income statement and the balance sheet. Again, balance sheet effects, because you do have an ending inventory. And is that ending inventory being overstated or understated? So you'll need to understand that. Okay, we're going to be wrapping up this chapter. We only have a couple more slides here, so let me talk about a couple ratios. Inventory turnover shows how many times a company is selling its inventory during a particular period. And this is an indicator of how well management is controlling the amount of inventory, because inventory consumes cash. And of course, there is an additional cost if you have to finance that inventory, as well as store it and protect it. And so this inventory turnover is tracked by how many times people can sell their inventory. Stores and retailers and wholesalers need to keep a healthy level so they don't run out and lose sales, but you don't want to be carrying an excess amount, and this helps manage that process. And so you see the cost of goods sold over average inventory. When you see average, take some beginning value, which could be the ending of last period, and then the ending of this period, whether that be the month or a year, and then just divide by 2. And so you're going to see this average in many ratios. So understand the average is beginning plus ending divided by 2. And that beginning and ending could be whatever period that you have information available. Days sales and inventory. Again, this is another way of measuring it. It's just measuring your ending inventory over your cost of good times 365. You want to know how many days of inventory do you have that are you keeping. And again, this is tracked by various industries quite carefully, both from a credit standpoint as well as an investor standpoint. And so these ratios are going to be seen in every chapter from here on out. And again, chapter 17 will focus on this to a large degree. It will be part of the project in accounting too. I'm not going to go into the global view, and I'm not going to discuss this under a periodic system. I think that'll be just extra. Again, inventory estimates. You might want to look at this slide, follow it through. It does talk about different methods, so forth. But I think the bucket will help you in calculating those 4 different ways of seeing how to do that on the test. Will probably be better than trying to memorize this, I think, because you can work your way out of it through the bucket. That's the end of this chapter, and we'll see you for the next chapter. Thank you.